right then. Okay, so we'll be talking about income and some of the expenses that we all have as individuals. Again, you'll see some parallels with managerial accounting and the income and expenses that companies have with personal income and expenses. All right, well, at this point, you know enough about accounting. You know that income is what you've earned, right? Whether it's through selling your product, whether it is from an investment, whether it's from a job. And it's that income that becomes assets, right? Like money, once you receive it, it was income during that period, but it's also an asset. If you spend it, you don't have that asset anymore. But if you hold on to it, you still have the asset. And if you hold on to it and you invest it, then your assets grow. So that income is the basis, right? You have to get the money in so you can then save it and invest it. So thinking about income, I found this, this is from just in December, this study that said the bachelor's degrees with the highest median income, according to the census, that's the every 10-year research that's done by our federal government to find out how many people live in the US, how much do they earn, where do they live, all that kind of stuff. So out of the census every 10 years, we get a wealth of information about the American population. So according to the census, engineering is the bachelor's degree that provides the highest income. If you're not familiar with this word median, well, when you take statistics, you'll learn median. But basically, it's like if you took all of the incomes, let's say in the engineering field, and then whoever is in the middle, let's say you've got 1 million engineers in the country, whoever is the one, not with the lowest pay, not with the highest pay, but exactly in the middle, their compensation is the median. So it's not exactly an average, but it is usually fairly close to the average. So the median income for people with an engineering bachelor's degree is $111,600. People with degrees in computer, math, and statistics, you see 100,000. Physical and related sciences, I guess that would be like geology, biology, things like that. A little lower. Actually, I think biology is probably on the lower end, but if you average out that whole range of sciences, it comes out to about 86,000. And then business, you see, is under that. And then social sciences, even a little bit less. So if you were going into business because you think that's the best paying type of job out there, maybe, maybe not. On the next slide, I'll get into some of the business majors that do pay the best. But in general, having a business degree doesn't necessarily guarantee a huge income because there's so many business majors, so many business grads, and it's such a general field that a lot of companies are not that impressed by just a business degree. More impressive if you have a business degree with a specialization in something that's in demand, like accounting, like data analysis, something like that. Let me zoom in on this other image here. There is the thought out there that, oh, you don't really need to go to college. Well, let's take a look at that. And there are some people who've been incredibly successful without going to college, without getting a college degree. But in general, I don't recommend it. So this is cumulative growth in hourly wages from 1979 to 2007. What is that? 30 years, approximately? So people with less than a high school diploma, they have seen their wages drop over the years. Now, how this was calculated, it doesn't mean that an individual person is making less, but once you factor in other factors, in general, wages for people who do not have a high school diploma have decreased pretty significantly. That's more than a 20% drop. Then if we look at people that have a high school diploma, but that's it, you see their wages have declined, not quite as much. People with some college, kind of been up and down, but in general, not so good. People with a college degree, you can see their wages have increased. And if you have an advanced degree, increased even more. I think what that tells us is a lot of the jobs that used to exist that you really didn't need an education for, but you could make good money, are hard to find. Used to be, you could just go get a job at the factory, especially if it was a union job, and you make a good income, and you can even support a family back in the maybe 60s and 70s. But those jobs, those low-skilled jobs or low education requirement jobs are less frequent because they've been replaced by robotics and automation. So the jobs that pay well today tend to be jobs that you have a degree for, especially if it's an area that's in demand. Questions or comments so far? All right, well, let's look at business majors specifically. Now, this is from 2019, one study. So take it for what it's worth. It might not be still the most accurate, but it gives us a general idea. If you're going to be studying business, these are some of the areas that tend to pay well. Business analytics, which would be related to data analytics, where you're able to analyze how successful a business is. Is it a good investment? That sort of thing. You can see that pays a pretty good income, right? Actuarial science, also pretty good. Who can tell me what is an actuary? What do they do? Anybody know? So actuarial science leads to jobs with insurance companies where you figure out, given a certain set of parameters, how much to charge for the insurance. So they would set up the software, for example, let's say it's car insurance. They would say, okay, what's the make and model of the car? What is the age of the car? How old is the driver? Does the driver have a college degree? What geographic area is this? They take all these hundreds of different factors so that when you apply for insurance and the insurance agent puts it into the computer spits out a price that's customized based on all the data that you put in there or the agent put in there. That's what actuaries do. They figure out how much insurance companies should charge. So it's a lot of math. A lot of statistics, correct. Now, interestingly, number 3 here, using your business degree for government. So majoring in government-related business, like doing accounting for business. In fact, just last week, we had our annual meeting with our Business Advisory Council. All of the different disciplines do this here at Hartnell College. We invite local businesses to come and meet with us faculty members and our dean and talk to us about what are they looking for in our students. And one thing that was mentioned is, in fact, it was somebody at Monterey County that was saying, hey, if we had people that knew government accounting specifically, that would be amazing. We don't teach that. But now we're starting to think maybe we should have a class in government accounting to fill that specific need. Or you can apply your business skills within government in other ways. Every government entity's got people that manage it, right? People that do the recruiting and do the HR and do the operations and the marketing, even governments market. So you can use your business degree towards government. You could focus on construction project management. Project management is part of business. And there's so much growth in construction right now, especially because of the infrastructure bill that got passed a couple of years ago. There's so much money going into fixing roads and bridges and things like that. That is a huge field. And international economics. So those would be some things to think about if you're a business major and you can have a concentration in one of these areas. That might lead to the highest paying jobs. Any questions or comments? All right. Now, whatever money you earn, you don't get to keep all of it, right? Like when we learned about payroll, we learned that there's your net pay, but there's also your gross pay. Your gross pay is what you earned. Your net pay is your take-home pay. Well, one of the things that comes out is your FICA taxes. Remember that from financial accounting? Your Social Security and your Medicare. So let's talk a little bit about that. Did you know that Social Security is actually called Old Age Survivors and Disability Insurance? So if on your paycheck, when you're looking at the pay stub portion where it explains how all the numbers got calculated, and you see OASDI, that's what it stands for. It's your Social Security. Because it's not only for your retirement. Social Security is also for people who have a long-term disability or orphans, for example. So it can be, there can be other people besides retirees that can collect Social Security. So this was established in 1935 under Franklin Delano Roosevelt. And the way it works is, you probably remember this, 6.2% of your paycheck goes towards Social Security. Up to, I think it's about $160,000 or so. If you earn more than that, then you pay a smaller percentage. They don't take anything out above that amount. But if you are an employee earning less than that, it's 6.2%. It comes out of your paycheck, and your employer contributes 6.2% as well. Now, if you're self-employed, and you contribute 12.4%. So you end up paying more in taxes if you're self-employed. Okay, and then at age probably 67 for you all, or my generation, it was more closer to 66, but you reach an age that's called full employment. Full benefits. If you retire at that time, you get your full Social Security benefits. But that's not that clear because you can retire before that as early as 62 and start collecting your benefits. In fact, in some cases, you could still be working and collect your benefits. But if you start early, like 62, you're not going to get as much money. And if you wait, you can wait as long as age 70 to start collecting your benefits and get more money. That's why I said calling it your full benefits is not completely clear because you can actually get more than that. So sometimes people aren't sure. Should they start collecting Social Security at 62, the soonest, or wait till 70? And that kind of depends on your health and your financial needs. You don't really need the money at age 62, and you can wait. It grows about 8% per year. So if you wait, instead of starting at 62, you start taking out the benefits at 70, it's gonna be at least 60% more that you're gonna get in your Social Security checks. So it's a pretty significant difference if you can wait. But if you have health issues or you need the money, then you might want to start taking it early. And there are all these weird loopholes with Social Security law. Like, let's say you were married to somebody for 10 years. Actually, let me back up. Okay, you're married to somebody and you go to claim Social Security. Let's say one person had a high income and the other person had a low income. The spouse with the low income can instead get half of the spouse's higher income Social Security benefit. So for example, let's say one spouse qualifies for $4,000 a month. That would be pretty high, but let's just say $4,000 a month in Social Security benefits. And the other spouse only qualified for $1,000. Well, instead, they could get $2,000, which would be half of their spouse's amount. And their spouse still gets the $4,000. And you would think it would be automatic, where the Social Security Department would just figure out what's the most you qualify for. But no, you kind of have to ask them. So if you know people that are close to that age to start taking Social Security benefits, I would recommend you have them talk to somebody. I know it might be a long wait to talk to somebody, God bless you, at the Social Security Administration, but ask them, is there any way to increase my Social Security benefits? Do I have any other options? Because sometimes there are these weird loopholes.
You said do they currently still have to be married or?
No. So that's what I was going to get to. Let's say you were married to somebody. I think you have to have been married at least 10 years. And maybe you were married to a couple different people each for at least 10 years. And now it's time for you to start collecting your Social Security. Even though you're divorced from that person, you could still get half of what they qualified for. And again, it does not reduce what they get. It's just that your Social Security benefit would be based on half of theirs.
You might know the answer to this.
I don't think so. I don't think so. Because the thinking is, hey, at one point, you were used to a certain type of income as part of that couple, and so you should qualify for that level. So all these weird little loopholes. Yes,
even if they married someone else.
Yeah, even if you married. I think so. No? Okay, the spell says no. So then you have to get another divorce.
Marriage, living with them, but not living married.
Yeah.
So you just receive your ex or.
Right.
No,
Okay.
but like, what if your person you got divorced to got married again?
Yeah, it doesn't
Yeah.
matter if they're married or not. Okay, so Liz Bell knows more about this than I do. So talk to her. So what else? I think that's it for Social Security. Any other questions? Okay, Medicare. Oh, and by the way, your Social Security does get taxed too. So whatever benefits you qualify for, you don't, you end up paying taxes on that. I think you can thank Reagan for that, if I remember correctly. Yep. And so then Medicare, you can start qualifying, well, you qualify for that at age 65. Now, when you work, you contribute 1.45% of your paycheck, and your employer matches that 1.45%. And that qualifies you for Medicare when you turn 65. Now, that doesn't mean it's free. There is a cost for Medicare, but it covers your medical costs. Everybody I know with Medicare, well, they love how much it covers. I'm not saying it's a perfect system, but people in retirement, that's their insurance, and it covers basically almost everything. There is something called Medicare Advantage out there, which is really heavily marketed, so that when you qualify for Medicare, you could instead do Medicare Advantage. When you do that, it's not actually Medicare. It is a private health insurance that offers a lot of perks, like free gym membership. Sometimes they'll offer vision care and dental care, so it sounds really good, but it's for profit. These organizations are trying to make a profit. Some of them might be nonprofit, but they're not Medicare. And the way that they make a profit is by denying care in some cases. So I would be really cautious before signing up with a Medicare Advantage plan. I know Congress is looking at it. It sounds too much like Medicare, so they're talking about changing the name so that people realize it's not actually Medicare, and maybe putting more restrictions on these companies. Because you wouldn't want to be in a situation where, oh, yeah, this Medicare Advantage sounds great, you sign up for it, and then at some point, some doctor is saying you need a certain procedure, the insurance company is saying, no, we're not gonna pay for it. If you have real Medicare, that does not happen. Whatever the doctor says you need, you get it. So I think that's it. Any questions on Medicare?
You should watch the John Oliver.
Yeah, I think I did see that. Yeah. There is also Medicaid. Medicaid is different. It's based on income. Then there's also Medi-Cal, which is the California state insurance coverage, which is also insurance income-based. But Medicare is the federal program for everybody that qualifies and is at least 65. Another expense we all have is our income taxes, right? So for this year, if you are married and you're filing together, because you do have the option of filing separately, which usually is not advisable. Usually for married couples, it works out better. They pay less in income tax if they file together. So you're not taxed on the first $29,200 of your income. So that is the standard deduction that you get. If you are a single taxpayer, or if you're married and you're filing separately, then you're not taxed on the first $14,600. If you have more deductions that you can claim, like maybe you had huge medical bills one year, instead of taking the standard deduction, you can itemize all your deductions and maybe get more of a deduction than this. But for most people, it's easier and they pay less taxes if they just take the standard deduction. If you are single and you have a dependent, for example, a single person with a child, then your standard deduction is $21,900. Okay. So that means if you make less than that, you don't pay any income tax at the federal level. And if you make more than that, you would only pay income tax on whatever you earn above that level. Now, there's also state income tax, right? So you can see here, let's see, is there a date on here? 2021. So this is not too old. You can see what are the income tax rates in different states. And they vary. In California, as of 2021, it was 13.3%. That was the top marginal individual tax rate. That's the highest amount that somebody might pay on their state income tax. Most Californians pay a lot less than 13.3%. You see, there are some states, the gray ones, where there's zero state income tax. So you would think, oh, move there. Let's go to Nevada, right? Let's go to Wyoming, South Dakota, or Texas. Well, yes, the state income tax is zero, but they get you some other way. They might have higher sales tax, higher property tax, something. Like, let's see, New Jersey. Can't really see it over there. Okay. Next, right here, this one here. New Jersey, I've heard that if you own a house in New Jersey, your property taxes are like 4%. Wow, and the state income tax is not that low either. So in New Jersey, you pay about 3 or 4 times as much as Californians pay on their property taxes. So yeah, you could maybe save on state income taxes someplace else, but why would you want to leave California? I think this is the best state. I really do. All right, any questions on income tax rates?
I question if it's one less person, yes.
Oh, move to Texas, right, yeah, Elon Musk
Go.
has been
Go.
threatening to move Tesla to Texas. Has he done it?
No, but it's,
Yeah. Yeah, I mean, okay, sure, there are some downsides to living in California, but are we not the most populous state? I believe we are the most populous state, right? And we have the 5th largest economy in the world, just in the state of California. Musk can go to Texas. I won't miss him.
we'll throw a party.
Yeah, there you go. There you go. So, okay, let's talk about these marginal tax rates. I mentioned that there is the standard deduction that everybody can take on their income taxes, and you don't have to pay any tax, any income tax on your earnings up to that amount, right? And then above that amount, you would pay 10%. This is assuming you're a single filer, not married. So you'd pay 10% on your income up to $11,600 above that standard deduction. At least this is my limited understanding of how our tax law works. Anything you earn above that, you're going to pay 12%. So between 11,600 and 47,150, that amount gets charged 12%, right? So this first amount was at 10%, the next amount is at 12%. The next, about $50,000 of income gets taxed at 22%. So the more you make, the higher the marginal tax rate that applies to the top part of your earnings. So currently, the highest marginal tax rate for income taxes would be 37%. But it's only on the top portion of that person's earnings. And that's only for people making more than $600,000 a year. Any questions on these marginal tax rates? So this is interesting. This looks at these marginal tax rates over time. Okay, again, the marginal tax rate is the very highest federal tax rate on income, right? So we see back here, this is 1913, very low, less than 10% was the highest tax rate. And then it shoots up here to 70 something. Now, people with a low income, they're not going to be paying that much. This is mainly people with high income that are going to be paying on some of their income more than 70%. And that's just federal. They might also have state income tax, right? Which seems crazy. Like most of their money is going out in taxes. But this period of time here where tax rates were really high was the roaring 20s. The economy was really good. And Congress said, hey, we don't need such high tax rates. Rich people are paying too much in taxes. Let's drop the tax rates. So they dropped them down. Income tax rate came down, what, less than 25% here. What happened in 1929? Yeah, the stock market crash and the Great Depression that followed through the 30s. Is there some correlation? They dropped the tax rate and our economy hit the wall? Maybe. I'm not an economist, but I'm a conspiracy theorist. Okay, so then in the 30s, again, it's the Great Depression for that whole decade, right? A lot of people in poverty, a lot of people struggling, a lot of businesses went out of business. But you see that as we dug out of that, what happened to the marginal income tax rates? They went up. reaching 94% during World War II. 94%. Some rich people had to pay 94% of their income to the federal government. On some of their income, right? Not all of it, but some of it. Which again, seems kind of crazy. But our economy boomed really through the 40s, 50s, 60s. It was doing really well. Then we hit 1980. Reagan lowers our tax rates. Okay, we start to have some economic problems in the 80s, more economic problems in the 90s. We have the dot-com bubble, we have the housing bubble, all these economic issues. So as our marginal tax rates have come down, our economy's gotten a lot more volatile. And we've seen the middle class really get squeezed. So it seems to me like having a high marginal tax rate helps prevent the ultra wealthy from becoming even more wealthy and helps, you know, keep the middle class somewhat viable. And when we lower those tax rates, it seems to help the wealthy and hurt everybody who's not wealthy. I could be wrong, but that's the way it appears to me. So if 37% seems like a high marginal tax rate, it's a lot lower than 94%, right? So that's where we are today with our tax rates. Questions or comments? Okay. Budgeting. So that's something that we will be working on. Today we're going to be looking at income and expenses. Everybody individually is going to be looking at their own. And sometimes it's hard to know, am I spending too much on housing? Am I spending too much on gas? So when you look at what Americans in general spend, you could kind of compare. Now, California does have super high housing costs, right? We know that. But still, if we look at this, this is an analysis of what Americans were paying in, is there a year here, in 2016, where their money went. You could sort of compare your own and say, does this seem in line with the average household spending and expenses? So nationwide at the time, 33% was the average for housing. In this area, it's not uncommon for people to be spending as much as 50% of their income on housing. Traditionally, financial advisors used to recommend 25%. But with rents going up, with home prices going up, you know, that's really hard to do. If you can find a way to get your housing costs down to 25% of your budget, you know, that's great. Like my daughter, for example, she has 4 roommates and it works out. Everybody pays somewhere around $1,000, right? So which is somewhat reasonable, but they share, right? They have a shared kitchen and so forth. So sometimes you have to be creative. My son, for a while, was living in actually he still is, living in like Airbnbs and hotels. And it was actually cheaper for him to do that than to rent an apartment. So whatever works. And you didn't have to worry about like maintaining it, right? If you live in a hotel, they just come and they clean it for you. Of course, you don't have a kitchen typically, right? But he doesn't cook, so he doesn't care. He can cook, he just doesn't. So, okay, so there's housing, transportation, this would be cost of your vehicle with gas and maintenance, or public transportation. Comes out to about 16% on the average. Food, about 13%. Those are the big ones. Healthcare, 8%. Insurance and pensions. Now, not that many people have pensions anymore, so that might include retirement plans. 12%. 5% entertainment. Now, 3.6% cash contributions. It's not super clear. I think that would be like charitable donations. I think that that's what that is. Apparel and services, so haircuts, and clothing, things like that, 3%. And then everything else, 7%. So this gives you just a rough idea of what the average American household budget looks like. Questions or comments? What's the advantage of creating a budget for yourself and knowing this is how much I plan to spend on this is how much I plan to spend on that? How would that be beneficial? Remember, we had a chapter on budgeting for managerial accounting, right? For companies do the same thing.
That's to be a good way to live and spend.
Yeah. Set some goals for yourself, right? Let me see if I can get my Starbucks budget down, to $100 a week or whatever it is. From 200. I don't know if anyone spends that much at Starbucks, but hey, that is not cheap, right? What was that, Joe? $5 or something? Is that drink? It adds up. So having a budget, I think just the process of creating it is an educational process if you don't already have one. It forces you to really think through what you're spending money on. And then, like Justin said, it gives you something to measure against and see, how am I doing? Am I sticking to this budget? Okay, so how can you do that? How do you stick to your budget? So here are some ideas. So being frugal, looking for ways to economize and not spend too much money. For example, I'll use this example. My wife and I were going to buy a piano. Actually, I wanted to rent a piano, but we looked at the price of renting a piano and thought about, well, you pay all that money, but then you don't have it anymore, right? It's not yours. So we thought, okay, let's buy it. Let's buy one. But the cost to buy a piano, when we went to a piano store to check them out, even used pianos, the good ones, were like $8,000 and up. So like $80,000. So even $8,000, that's a lot of money to spend on a piano, right? And my wife's a fantastic pianist, and I play a little bit. So we wanted a decent piano, but we talked about it. We thought, 8,000 is it's so much money. I threw out the idea, why don't you teach piano lessons, and that will help pay for the piano. That did not go over very well. So I was like, okay, I guess we're not going to get the $8,000 piano. So I went on Craigslist, and I found a piano just as good as the $8,000 piano for $1,200. That was way up past Oakland, but I hired a company to bring it down. I think they charged about $700. So altogether, we still came out less than $2,000, right? So sometimes by shopping around, being creative, you can find ways to save yourself some money. Another way, has anyone done mystery shopping here? At the bank? So some people will come in and like open up an account or do something, right?
Very specific thing. that
Exactly.
that you're supposed to follow.
Pretty much every industry today, from retail to banking to real estate, whatever, if there are customers involved, there is some company that will send out secret shoppers or mystery shoppers to pretend to be a customer so that they can send in a report and say, this is how the transaction went. This is what I had to do. This is how the office looked. You know, the person was wearing their name tag or wasn't. It gets very detailed. You can do that. You can sign up. Anybody can sign up to do mystery shopping. And you usually don't get paid for it. But what you get is whatever the product was, you get reimbursed for the cost. So I've done it a little bit in the past, where I've gotten like free meals, but other people I know have gotten their carpets cleaned, free hotel stays, all kinds of things. You just have to be willing to pay really close attention. Kind of like being a spy. You have to really, because you can't be taking notes while you're there doing the shopping. Right? That would give it away. So you have to just really, remember everything that happened. Maybe you sneak away around the corner where nobody can see you and you put some notes in your phone or something. But later you have to fill out a report and then you get reimbursed for the cost of what you purchased. So it's a fun way. You can get groceries for free. Mystery shopping. You can see movies for free. So all kinds of things. It is work. There is work that goes involved, but it's kind of fun. So that would be one way to possibly save yourself some money. Oh, and by the way, if that sounds interesting to you, there are scam companies out there that want you to pay to become a mystery shopper or pay for training. Do not do that. A legitimate mystery shopping agency does not charge you anything and does not charge you for training. Okay, so keep that in mind. What else? Stick to your budget. If you use, there's certain apps out there where you can set a budget in the app and it will connect to your bank account and it'll tell you like when you're reaching your budget. It'll send you little reminders. So some people might find that helpful. Okay, so some banks do it through their own website. Okay, in general, financial advisors suggest you have 3 to 6 months worth of your expenses just saved up. So let's say your expenses come out to $4,000 a month. That would mean $12,000 to $24,000 just in the bank. Maybe in a CD or a money market account, some kind of safe investment, but something where you can access that money if you need to. And that's a lot of money to just have sitting there, right? Why do you think financial advisors would recommend that instead of saying, invest that money?
If you lose your job.
Exactly. If some emergency happens, your car breaks down, you lose your job, then you might need to access that money, right? And if it's tied up in an investment, or if you invested it and lost it, then you don't have it available, right? So that is a general rule of thumb. That's not that easy. So what you might do, if you're working, have your employer direct deposit some of the money into a savings account that you kind of don't pay attention to. It just kind of goes in there. And you just get used to getting less money that you can spend. It's also not a bad idea to have some cash in case we have like a major electricity outage or earthquake or something, and you go to the store and you can't pay with your card or your phone, you might need some cash, right? So you might want to just have some cash that you keep at home, someplace safe where nobody's going to find it for that kind of emergency. Emma.
You should keep your cash in plastic bag, so if your house floods, your money won't.
Okay.
At the bank, that would help keep cash in hand,
Hmm.
and then their house got flooded.
Yeah,
It's unusable.
and we had huge floods, it was just last year, right?
Yeah, if you're gonna
So-
do that, keep it in a water safe bag.
Good point. Keep your money in a water safe bag. It's a good idea to also have like just a go kit, they call it, or like an emergency kit with a flashlight and Band-Aids and all those kind of things that you might need in an emergency. Okay, real estate. That's always an interesting topic, right? So if you are now, or at some point, in a position where you're trying to decide, should I rent or should I buy a home? There are pros and cons. Let's look at them. If you buy a home, the interest on your mortgage, your loan, I'm assuming you're not going to pay cash. Not too many people around here pay cash when they buy a house unless they are like some private equity firm or some just super wealthy person. So if you take out a loan, the interest on that loan gives you a tax break. So it saves you some money on your taxes. And you can depreciate that home. That depreciation reduces your tax liability as well. And when you take out the loan, if you get a fixed mortgage, your payments for the mortgage stay the same throughout the life of the loan, which might be 30 years. So you're in a position in that situation where you know what your payments are going to be for your home for the next 30 years. Somebody who rents can expect their rent's probably going to go up every year, right? And you locked in that fixed rate. If you get a variable rate mortgage, it can go up and down. So you got to be careful with those. I would recommend, if you can, especially when interest rates are low, lock in a fixed rate. And there's a chance that the home that you bought goes up in value. They usually do, right? So then if in the future you sell that home, make a profit. And if you sell the home, if you've lived in it, I think it's for 2 out of the last 5 years. When you sell it, you don't have to pay taxes on the gains up to $250,000. So if you sell it for $250,000 more than you paid for the house, then you don't have to pay any income tax on that gain. Okay. If you are married, you each get that $250,000 exemption. So that's $500,000 of growth in the value of that home that you then don't get taxed on if you've lived in the home for a certain number of years. And California honors that too with state income taxes. That's nice. That's how a lot of people, you'll see that they live in an area like ours where home prices are really high, and then they sell when the market's high and they move to someplace where it's cheaper. Well, sometimes it's because they did that. They got all this growth in the value of their house and they cashed it out tax-free. Pretty good strategy. And then you could do it again a few years later if your home price went up again. So those are some of the pros, some of the advantages of buying a house. Questions or comments? All right. Well, what are some of the downsides? You have to maintain the house. My wife and I have a couple investment properties. Just had to put a new roof on one of them. Ouch. $24,000 for the roof. So it can be expensive to maintain a house. I had to have it tented once too. It had termites. Property taxes. Something in the neighborhood of 1%, maybe a little more here in California, that you're paying every year on the assessed value of that home. In some areas, especially newer areas, there can be an association fee, especially if it's a condo. Now that's an extra cost you have to pay just because you're part of a homeowners association. If you do not qualify for that exemption I told you about when you sell the house, you have to pay income tax, well, capital gains tax on the profit you made from the house. And if you took depreciation, you get taxed on that depreciation that you took. So that could really hurt. In fact, I probably would have sold our 2 investment properties a long time ago, but for this depreciation recapture thing, the tax I would have to pay, even if I sold them at break even or a small profit, I'd have to pay so much in taxes, it's just not worth it. And then what if the house goes down in value? You might not be able to refinance, so you're stuck with that loan. Can't sell it because it might not be worth enough to even pay off the loan. And you see people that lose their houses, it's usually because they got in that situation. They got into it, price went down, and they couldn't get out of it. So for some people, it just makes more sense to rent. Okay, well, a lot of factors to consider. Questions or comments? Come on.
In a condo, neighbors are disgusting. I can't do anything about it. Kind of mind if you're looking at a condo.
Okay.
My guidance that two of my neighbors had an infestation. And the HOA, even though we have all this mighty power, are not allowed to go into their unit.
Okay.
About it.
Yeah, you get into a lot of legal issues. So if you don't know, a condo is where you own and are responsible for the inside of the unit. The outside of the unit, the association's responsible for.
And the water.
And the water line, things like that. And there's an association that manages it, but there are laws that even they do not have power over. I had a situation in one of our investment properties where I had a tenant that refused to move out. It's really hard to evict somebody. It's expensive and had to take her to court. It was a mess.
And if the, I don't know if you saw just on that you do get under condo, like the HOA can let a condo out.
If you don't pay the association dues,
Or just like, I think you can.
really?
There's like, he was talking about, I can't remember if it was both, but
Okay.
they bought this lady's condo out from under her, like,
Or sometimes if people forget to pay their property taxes, then their home goes into default and somebody can buy it out. All kinds of crazy stuff. So if you're gonna make a real estate purchase, that's why you work with a real estate agent who knows the rules and the laws, and they can advise you properly, Christina. Yeah, so if somebody just like let's say there's a vacant home, there are a lot, like in Carmel, half of the homes are vacant because they're owned by wealthy people that don't live there. And so if somebody just moves in and the owners discover that there's somebody living in their house, they have to go through a legal process to get them evicted. It's not that easy. You can't throw them out yourself. And you can't just call up the sheriff or the police department. There has to be a whole process you go through.
you can actually get arrested.
Is that like
Mhm.
But it's
Yeah, it's just the way the law is. Yep. So this graphic shows us home ownership and how it's changed over the years. So this is going back to late 60s up until, what is that, 2020 or so? So we went from 63% of Americans owning a home at the peak, about 69%. So about a 10% increase from there to there. Right? Like 10% of 63 would be around 69. I mean, 10% more. But then you see it really came back down. Now, if we look at this historically, first of all, let me point out these gray bars are recessions. Times when the GDP of the United States was declining. So recessions come and go. On the average, it's around every 7 years. We had a tiny, like 2-month-long recession, which is not really a recession, during the pandemic. But we really haven't had a real recession since 2009. We're way overdue for a recession. Not that I want one, but don't be surprised if there's one around the corner. But there does seem to be some correlation. You see a pretty big recession here. That was around 2009. Yeah, that was the 2007 to 2009. They called it the Great Recession. Well, the 2008 financial crash was right in the middle of that. And that's not a coincidence. We had another one here. What is that? Early 80s. A couple others. So it's not a perfect correlation, but there does seem to be some relationship between these recessions and less home ownership. Now, the housing bubble peaked around 2005, and you can see that on this chart. A lot of people were buying houses because the rules have been changed to make it easier for people to qualify, but there was something else going on. Wall Street and the banks and the credit rating agencies and some of the realtor agencies had kind of rigged the system where they're making a ton of money getting people into homes that they knew that they couldn't afford, which fed this whole Wall Street bubble too. And then when it became clear that, hey, these people can't, or some of these people at least can't afford these homes because guess what? They're not making their mortgage payments anymore. Then the whole thing came tumbling down and we got the 2008 crash. So today, there's a lot of relationship between what happens on Wall Street and what happens in the real estate industry. There's a lot of cross-pollination between the housing and securities markets. So when the housing bubble burst, the Wall Street bubble burst, and investors had no place to put their money, the ones that had any money left. Stocks were down, bonds were down, homes were down. It was a good time to buy if you had money. And you could buy investments on the cheap, but most people had lost their shirts. So then, anyways, home ownership really declined. It's started to take off again. 2015, we had a peak right here in 2020. A lot of people said, hey, let's move out of the big cities because now we can work remotely. Let's go buy a house someplace cheap, Texas, or someplace where you can still buy a house for cheap because nobody really wants to live there except Elon Musk. And so home ownership went up very briefly, but then you see it dropped just as quickly, right? So I don't know what the future holds. It seems to me the housing market, even though it's come down a little bit, it's still like way out of bounds for most people. So I'm sure we're going to see changes in the housing market in the coming years. But what those changes will be, I don't know. Okay, that is the entire section on income. Questions or comments? Emma?
For anybody looking for you need to do their
Okay,
big deal about it.
yeah.
Like it took me a long time to find anyone.
Are you talking about the FHA?
Yeah.
Okay, so the Federal Housing Authority does have programs to help people who are first-time home buyers, which you don't necessarily have to be a first-time home buyer to qualify for. If you haven't bought a home, I think in 5 years, they still call you a first-time home buyer. So there are loans where you can have a down payment, like maybe 4%,
I think it's
3% in some cases, which makes it much easier to get into a house, but that doesn't mean you can afford the payment, right?
Yeah, and like most of the areas that I looked at here, when we were gonna buy,
Yeah,
they wouldn't.
and not everyone's gonna take that loan, and it's not the best, the most economical way to finance your home either. So it might be the solution for some people, but not for everybody. Or 20% ideally, right?
Yeah, conventional.
Yeah. Okay. Any other comments or questions? All right, well, let me show you what we're going to do next. I'm going to stop recording first.